Welcome to WCS Money Tutorials. Today's topic is the home sale exclusion, how to exclude up to $250,000 or $500,000 if married filing jointly of capital gains from the sale of your principal residence. To qualify for this exclusion, you must have lived in the house and owned the house for an aggregate of at least 2 years of the 5 years before the sale, and you did not claim the exclusion within 2 years before the sale. A principal residence can include a mobile home or a condominium. The exclusion amount is $500,000 for married couples filing jointly and $250,000 for everyone else, and this exclusion can be claimed every 2 years. To qualify for the exclusion, you must own your house and use it as your primary residence for an aggregate of at least 2 years during the 5 years before the sale. The 2-year ownership test and the 2-year use test can occur at different times. Likewise, neither time period needs to be continuous. To claim the $500,000 exclusion, either spouse must have owned the residence for at least 5 years, and both spouses must have used it as the principal residence for at least 2 years, and neither spouse claimed the exclusion within 2 years. Co-owners, even if they are unrelated, can claim the full exclusion. The use and ownership tests must be satisfied for a newly built home, even if the home is replacing a demolished home on the same site. Members of the military and certain other employees can suspend the 5-year period for up to 10 years. A newly married couple may not claim the full $500,000 of gain until both spouses have used the house as a primary residence for at least 2 years. If your spouse dies before the sale, then you are still entitled to the $500,000 limit if the house is sold within 2 years after the year your spouse died. If you receive your primary residence as part of a divorce decree, your time of ownership will include your former spouse's time of ownership. If you move out of the home that you owned or jointly owned with your ex-spouse, then you will be treated as having used the home as long as you have an ownership interest and your ex-spouse continues to use it as a principal residence. You may still claim an exclusion if you are forced to sell your home before qualifying for the full exclusion because of a change of employment, health problems, or other unforeseen circumstances. The maximum exclusion is reduced to a percentage equal to the shortest time in days of your use or ownership periods or the time since last claiming the exclusion divided by 730 days, the number of days in 2 years. Note that if your gain is less than this maximum, then you could still exclude the entire gain. So if you buy a new home, but you live in it for only 146 days before moving because of a new job, then your maximum exclusion is reduced to 20% of the statutory limit, equal to $50,000 or $100,000 if married filing jointly. However, you can still exclude the entire gain if your capital gain is less than that, which is likely for such a short time. The income limits for the long-term capital gains rate are adjusted annually for inflation, as you can see in this table for the 2021 and 2022 tax years. If your income exceeds $200,000 or $250,000 if married filing jointly, then you will also have to pay the 3.8% net investment income tax on any gains that were not excludable and that exceeded the statutory threshold for the tax. If you claimed depreciation because you rented the place or you claimed the home office, then that depreciation is recaptured at the lower of your marginal rate or 25%. Recaptured depreciation is not excluded. Form 1099-S must be used to report the sale if some of the gain is taxable, or there is recaptured depreciation, or non-qualified use within the 5-year look-back period. Form 1099-S need not be filed if the gain on the home was less than the statutory limits for the excludable gain, or if the seller certifies that the gain will be wholly excludable. Otherwise, the closing agent must file this form for the sale. If this form is filed, then you must report the sale in your tax return. The total gain equals the sales proceeds minus the adjusted basis of the property. The capital gain equals the total gain minus depreciation. The main component of the adjusted basis is the purchase price. Expenditures that increase the adjusted basis include improvements with a useful life exceeding 1 year. The main factors decreasing adjusted basis include any depreciation claimed for a home office or claimed tax credits for home energy improvements. Non-qualified use is owning the property before using it as a primary residence during the 5-year look-back period. This provision prevents owners of rental properties or vacation homes from moving into their properties 2 years before they sell it so that they can claim the exclusion. They can still claim the exclusion, but it will be less. These are the steps to calculate non-qualified and qualified gain. Freeze the video if you want to examine it more closely. This example shows how much greater your excludable gain could be if you avoid the non-qualified use within the 5-year look-back period. You purchased a house on January 1st, 2007. And rent it out until January 2017. You move in on January 20th, 2017, then sell the property on January 1st, 2022. Because your non-use period ends 19 days after the start of the 5-year look-back period, you must use the non-use calculation, which reduces your excludable gain by $107,355. But if the non-use period ended on December 31st, 2016, then your entire net gain of $200,000 is wholly excludable. Note that you will have to still pay tax on any depreciation, which is recaptured at a rate equal to the lower of your marginal rate, or 25%. If you have depreciation, then you can use the unrecaptured Section 1250 gain worksheet in the instructions for Schedule D, then transfer that result to the appropriate line on Schedule D. If you must report a home sale, it is reported on Form 8949, Part 2. Fill in the columns for the home sale. If you had $20,000 of selling expenses and $200,000 of excludable gain, then you enter the selling expenses as Code E and the excludable gain as Code H in the appropriate column. Add the two together and put the negative result, indicated by parentheses, in column G. Then report the gain or loss in column H. The sum of all your gains in Part 2 is then transferred to line 10, Schedule D. The home sale exclusion does not increase AGI, so it will not increase your capital gains tax rate, and you may even still benefit from tax credits where either the eligibility or the amount of the credit is limited by AGI. So if you are married, filing jointly, and your only income is $100,000 of qualified dividends, then your capital gains tax rate is 0%. If you sold your home for a $500,000 gain that you can exclude, then you would still qualify for the 0% capital gains tax rate on your investments. And if you wanted to adopt, then you could even qualify for the adoption credit of almost $15,000, which you would otherwise be ineligible for because of your income. Indeed, excluded income is the best type of tax benefit available. Keep records of all adjustments to adjusted basis for at least 3 years after the due filing date for the tax year of the home sale. Although it is a nice tax benefit for those who can take advantage of it, the home sale exclusion costs the government an enormous amount of money in forfeited tax revenue. This screen is based on some rough statistics, but they do give a good ballpark figure of the amount of revenue the government is forfeiting by excluding gains on home sales. No one can doubt that it is a huge amount of revenue. The amount of money the government is losing because of this exclusion increases with inflation because residential real estate prices increase with inflation. The higher the inflation rate, the faster the increase in real estate prices. Although this pandemic is costing the government a great deal of money, taxing property sales like work would help pay for the pandemic, especially considering that much of these gains are being created by inflation itself. The government would simply be taking back some revenue that it is creating by the printing of money. However, the home sale exclusion is probably here to stay, since it is a popular tax benefit and, most importantly, it benefits politicians. Thank you very much for your time. If you liked my video, please give me a thumbs up and subscribe. I would appreciate any suggestions, so please leave them in the comments below. Thank you.